It is projected by people much smarter than me that we will see fixed rate loans with APRs around 6.5% by the end of July. We will not even be finished with our second quarter of GDP going down, so the recession technically won't start until August or September.
I read something like 21% of all money in circulation was printed in like a very short period of time, like 18 months. Because we say like, this is my home. I'm like, really? Don't make your payments. See whose home it is. Welcome back to another episode of the Residual Real Estate Agent Podcast. Yes, episode number 116, and we have with us the man of the hour, the guy that everybody wants to speak to in real estate right now, Mr. Bob Davis. He is a wizard at mortgages, interest rates. He's been doing it for an exceptionally long period of time. We're really appreciative of you taking the time to be with us today, Bob.
You're welcome. I'm glad to be here. Thanks for asking me.
Bob, thank you so much. So I asked a good friend of mine, I said, who understands mortgage interest rates better than anybody else? No hesitation. Your name came up immediately. So we're really happy to have you on. For our viewers out there, the reason I wanted to bring Bob on is there's a lot of things going on with mortgage interest rates right now. Interest rates have been increasing substantially. And I wanted to kind of just have Bob give us a history of interest rates, mortgage interest rates. I want him to explain to us who controls mortgage interest rates as well too, and kind of just the dynamics of how they work. That way, when we see interest rates going up, we can understand them at a deeper level and just kind of know how they work. So before we get started with that, just a quick intro, Bob. Who is Bob Davis and how did you get involved in this wonderful world of mortgage?
Good question. Back in 1977, my mother, who was a professional realtor with incredible success, back in the day, she would average 18 to 20 transactions a month back in the early 70s. And she looked at me one day and said, you know what? Since you're not going to continue to go to college, you're going into real estate. And being the good boy, I said, yes, ma'am. And for the next few months, I literally would sit with her probably 2 or 3 nights up until very late. And she would tell me how to sell real estate. I took the real estate license, off I went. So in 77, yeah, that's 1977, not 1877. I started selling real estate with a company called McElhenney Levy and people that are to me legends. I was fortunate enough to be trained by them. So you mentioned Vicente. I had several different people, and yes, that's my wife in the background, making sure that I do the right thing. When they came and taught me how to do the thing, Mom taught me really how to do, Jose, what you do, which is explain to people what they need, get to it, get her done. Well, fast tracking to 1983, I was not digging the fact that I was a young man and I was better known as Betty's son. She was selling $8, $10, $12 million worth of real estate a year, which back then the average price was $70,000. And I was doing quite well, but I wasn't doing that. So I went into lending. And to make a long story short, that's been my niche since 85. And I love it. I just love delivering to people, not only the money, obviously, but I'm really delivering the facts and the figures, stuff that you're going to ask me about today.
So let's get started with what's the history on mortgage interest rates? I don't know if you know that. Like when did mortgages come out? Like who controls interest rates?
Without boring everybody listening today and having you two fall asleep on me, interest rates, let's take that term and put it to the side for just a moment. A mortgage debt was an ability for somebody to borrow from a bank. Now I'm talking about pre-depression. And usually that was a farm loan. House loans just didn't really exist. Most of them were paid for in cash. So a farm loan was usually due in, 5 years. And every 5 years, the farmer went to the bank, probably dressed up that day and took a shower, said, hey, I need a loan for another 5 years. And the bank said, okay, you're a good person. You're making your payments. Well, when the Depression came, what ended up happening was the banks ran out of money. So they said to the farmer who came in for that loan extension, if you will, said, nope, we want the money. Well, the farmers didn't have the money. That's where the Depression, which is a totally different discussion and subject, that was a big part of how come that was so just terrible for everybody, not just people in the city. From that, entities called Fannie Mae and Freddie Mac were created. Not then, certainly not then, not until actually the 60s. But up until after the Depression, banks began to lend to people again. But they still had what we call balloon payments. There were no long-term 30-year or 15-year loans. So when the federal government began to think, oh, maybe it's a good idea we do that, they promoted home ownership, exactly what is done today. And the ability for the 30-year loan to come into play made home ownership a viable opportunity for almost every person in the 50s.
That's
Post-World
very.
War II, what's that?
Oh, I said that's super interesting. Like, so essentially at the beginning, banks would lend money, but there were balloon payments. They wouldn't allow you to do 30-year fixed mortgages. Is that right?
Didn't exist. Did
Wow.
not
Okay.
exist. So fast forward to post-World War II, the government started becoming very acclimated into that in a program called FHA, which stands for Federal Housing Association, VA, which stands for veterans to be able to get a loan. And post-World War II, that became popular. Well, it became so popular that when I started selling real estate in 1977, Jose's going to roll his eyes at this one. There was a big company called Home Savings of America. And in Ventura County, they would only lend $1 million a month. This is in 77, 78, 79, when we had what we're about to go into now, which is stagflation. There was plenty of money, but they were afraid. They didn't want to give it up. So we would sometimes have to wait to close our transactions for 2 months, because if we missed the window, if they used up all the money by the 12th or the 15th of the month, we had to wait till the next month. So when Fannie Mae and Freddie Mac got really involved with the market, and that was the 70s and the early 80s, that's when all of a sudden the spigot of money became available for homeowners. And what's that, Aaron?
Well, and can you, because I know there's a reason why that spigot got open. Can you explain how Freddie and Fannie, what they represent and what they provide to those that are lending money, and why they made it more kind of acceptable to lend money on
Sure,
homes?
you bet. Fannie Mae stands for Federal National Mortgage Association. There will not be a test. Freddie Mac stands for Federal Home Loan Mortgage Corporation. They're both quasi-government agencies, which means they used to have private ownership with the federal ownership. But a few years, not that long ago, 10, 12 years ago, they got taken over by the feds again because they were losing so much money. When they came in, their goal was to promote homeownership because that is a way that people are more stable. People that own a home, by the most part, will stay on their job longer. They will work better. They will be better citizens. They'll have more children. They'll spend more money. And this is long before Lowe's and Home Depot. So what it boils down to is the government was very clear in its inception of these two entities. And then another one came into play because the VA and the FHA market was becoming so prevalent. I mean, super prevalent in the 60s. They created another company called the Government National Mortgage Association, or Ginnie Mae. Ginnie Mae used to buy all the VA and FHA loans because they were either guaranteed by the feds through the VA or insured through the FHA. And let's think about it. If you're an investor, Aaron, and you want to invest $10 million, part of your portfolio is going to say, I want some real guarantee. Well, having the U.S. government guarantee it, pretty good deal.
Yeah, and for those who, if I'm understanding correctly, it's not just like people need to understand what a guarantee means. So a guarantee means is that if they default, they'll take it back. Is that right?
You are right. Yes. And more specifically, if a lender lends on a VA loan, most VA transactions have the opportunity for zero down payment, no down payment. They have no skin in the game, if you will. By the way, VA loans are the best performing loans, bar none, than any on the market. Consequently, that's one of the reasons that in most times VA loans and FHA loans have lower rates than conventional loans. But back to your point, the ability for the lender to be protected. If there's a foreclosure and they take the property back, they literally can sell it to Ginnie Mae, Freddie Mac, or Fannie Mae and say, give us our money back. Now, there are preclusions to that to certain indemnities, but the bottom line is they're probably not going to lose a lot of money.
So essentially, I mean, very much so financially engineering home ownership for the majority of people who want it.
Yes.
Yeah. Okay. Got it.
And the single biggest reason is it creates more tax revenue. Because if you think about it, if you own a home and you want to have a family, you're going to get a better job, or you're going to keep your job, and you're going to spend more money. You're going to buy a car because you know your landlord won't kick you out because you're your own landlord.
What I wanted to ask is when mortgages first started, has it always been like a fixed rate, or has that shifted at all? Like, meaning at some point, was it variable? Has it always been like a 30-year rate, or have there been any differences there besides the balloon payment early on?
You know, adjustable rate mortgages really were not designed until the mid 70s because there, quite frankly, was no need for them. The average interest rate from 1959 to 1979 was 7.25%. 7.25%, which means most people, and generalizations are bad. Would you agree with me?
Yeah.
So I'm going to give you a generalization now. 7.25%, a family household could afford the average house in their neck of the woods. Because if you live in big city New York, you're going to make more money than if you live in a small town in Nebraska. So the bottom line is and I'm sure there was some play with that with the federal government, but the bottom line is everything kind of worked. Well, in the recession of 73, and I remember it, but only because my mom sold more houses that year than she'd ever sold before, because in a recession, generally the real estate market does better and interest rates drop. So I remember she was commenting that the rates had dropped to 7% from 7.25%. And everybody was just jumping on houses. It was crazy. But there was no adjustables, Jose. So what ended up happening is in the late 70s, a company called Great Western Savings, which morphed into Washington Mutual, which eventually became any number of other companies, brought out an adjustable mortgage. That was my first one. It was 9.25%. It was adjustable. We paid 2 points, and we were thrilled to get it. And the reason adjustables were created is because it was easier for the consumer to borrow the money. Now, if you think about it, if you deliver to the consumer what the consumer wants, or in this case can afford, you'll sell a lot of it. So at that time, interest rates were 11% for fixed. Well, at 9.25%, that was a killer deal, right? And that's where adjustables, although they were in business years before that, they were just not popular.
Can I ask you a question real quick? You mentioned something that I didn't understand until Aaron explained it to me like a couple years ago. You said that in a recession, interest rates drop. Like, why is that? And yeah, why is that? Because I used to not look at interest rates like Aaron explained that to me years ago, but I think it's important for consumers to kind of understand.
Sure. A recession is technically when we have 2 quarters of gross domestic product that goes down. So we just finished the first quarter of this year, and it was down about 1.4%. We haven't had that for quite some time. What it really means is that this Main Street, or businesses, not Wall Street, but businesses that sell things on Main Street, and in our case, Thompson Boulevard, they don't sell as much stuff because the consumer has experienced inflation and has less money to buy stuff. When a recession comes into play, it is not because the consumer doesn't have enough money. It's because the business doesn't have enough sales. Theoretically speaking, then, you take the next step. Some of the employees at those businesses are going to get laid off. Now the recession hits the customer. Then all of a sudden, the next step in the process is, oh, we have to borrow more money to stay alive. We have to sell our home. We have to move in with somebody else. Well, the recessions, with rare exception, don't last for more than 9 months. But the after effects of them last for years. So we had a recession that most of us in the real estate industry missed in 2018 and 19. The last 3 months of 18 and the first 6 months of 19. Technically, we had a recession. And that's when businesses simply weren't able to sell enough stuff. And if you think about it, COVID came in at a really interestingly positive time for a lot of those businesses because they either got federal funding to stay in business, or in the case of the real estate industry, we were able to do a lot of business, make a lot of money, and provide a lot of services to people because of all the different antics of the market. Not the government so much, just the market. So back to the recession part. When we have a recession, that is precluded by the Federal Reserve raising the discount rate. That slows down business, enhancing the probability we're going to have a recession.
Yeah. Yeah, in an attempt to tamp down inflation, which we're at a 40-year high, at 8%. So what's interesting, what's fascinating to me, I'm taking notes as we're speaking, is that the adjustable rate mortgage is a financially engineered product to make things more affordable for people. And so with a high degree of probability, as we see interest rates continue to go up, we'll start to see more adjustable rates come into the market because people's purchasing power has been affected by almost $100,000 or more with the jump that's already taken place, right?
Completely agreed. In fact, adjustable rate mortgages, Aaron, came into the market with pretty loud noise in October, November of last year. And then we haven't talked about the secondary market yet, but the secondary market, which is in effect Fannie, Freddie, and Ginnie Mae, they said, oh, great, this will be good for us. And then they all of a sudden booked all those loans. So they bought those loans from people like us. And then they realized, oh, wow, rates are going up, and we did these loans really low. So right now, today, an adjustable rate mortgage has an average cost that is triple, that sounds terrible, but I'll explain more of it in a minute, than a fixed rate. So if a fixed rate has an APR of, say, 5.5%, to come close to that, and that's with no points, an adjustable has to charge 1.5 to 1.75 points for its lower rate to make it make sense for an investor to even buy that loan. Because if, as a lender, if I can't do a loan that somebody will buy, then we're not going to give it to the consumer.
Mm-hmm.
So,
well, that's super interesting because what that is that's a very key indicator that they believe very strongly with a high degree of probability that that rate is going to continue to go up.
It is projected by people much smarter than me that we will see fixed rate loans with APRs around 6.5% by the end of July.
Yeah.
We will not even be finished with our second quarter of GDP going down. So the recession technically won't start until August or September. But the Fed is always a laggard. And if they have the backbone to increase the discount rate as much as another 1.5% in the next 3 months, you will then see fixed rates begin to go down, and you will then see adjustables become a lot more affordable.
Mm-hmm. That makes total sense.
When you say discount rate, what does that mean?
The Federal Reserve is a private bank. It is not the government. It just happens to lend money that the government approves. And they will lend member banks, Bank of America, Citibank, big banks, not the Bob Davis Bank, a big bank. They'll lend money to them overnight. And up until very recently, that interest rate was anywhere from 1/4 to 0.3%. It was a very low cost. And that's on an annualized basis. So they could literally borrow $100 million, more realistic, $50 million, and not pay a lot of money to have that in their bank overnight to cover the checks you and I write so they can go make more loans, that kind of thing. So the Federal Reserve makes a decision as to what they're going to charge. They charge not you and me, they charge their member banks. Are you familiar with the term prime rate? Prime is a function of the discount rate because the discount rate is whatever the Federal Reserve says it is. And I encourage anybody that wants to take a look at this, Google it today. What is the federal discount rate today? And right now, today, it's about 0.5%. This time next month, it'll probably be 1%. And in 2 more months, it'll probably be about 2.5%. That means member banks are going to pay more for their borrowing. Consumers or businesses will also pay more. So if you have an adjustable mortgage, specifically a home equity line of credit, or if you have a credit card that is tied to prime rate, you will see those rates go up commensurately. But what happens is when that particular effect of a significant increase in the discount rate affects the mortgage market, that means the mortgage market says, oh, good, we're not going to have as much inflation in the next 6 months. We're going to lower the rates. What it really means is the investors who are buying the loans that we do are going to be more comfortable accepting a lower yield on their money. The bottom line of that whole thing when it comes to what's short-term, what's long-term, is understanding business cycles. And Jose, I've seen you in this market, so I know you know business cycles. The business cycle we're in right now is not pretty, it's ugly, and you have to be prepared for it as a buyer or a seller because the money's flat going to cost more for at least another 4 to 6 months. Yep. But there's benefits for that, huh? There are benefits.
When you said at some point that interest rates something would go down and then up, or I don't know if I misunderstood. What does that mean?
When the federal discount rate goes up, almost directly, mortgage rates will go down.
Uh-huh.
For example, last month, the discount rate was increased by 0.25%. The market yawned. It was nothing. It was totally a nothing. Rates actually went up because it was not near enough. Aaron, what'd you say the inflation was? 8%?
8%, yeah.
I mean, whether it's true or not that the Federal Reserve can fight inflation by raising this rate, that's what most of the market believes. And if they believe it, it will happen.
Well, what's really interesting to me, too, is like you mentioned cycles, right? So this is very much so predictable and duplicatable. You've seen more cycles than me and Jose has. What's interesting about this particular cycle is that it seems as though they've backed themselves into a corner in the sense that they really only have one tool to use, and that's it. And, because of that, it'll be interesting to see how that plays out, right? As far as cycles are concerned. And like you said, when you were saying that, I was like, winter's coming. But what's interesting is that, for people who know what to do in winter, it's actually like a really good season if you know what to do.
I agree with you. In fact, one of the things my mom taught me, and J.R. Pat Patterson, who was my first boss, told me, people do one of five things every year that own a home. They die, they divorce, they get bigger, they get smaller, or they just buy an investment. That means that 20% of the populace of people that own real estate want to do something with it every 5 years. Well, in the last 12 or 13 years, it's been every other year. That cycle has been created by the money created by the federal government. There's more money available than we can't lend the money that we have available. That's just not possible. Consequently, the consumer has been in charge. When these rates start to get increased, it will be that business will be the one to take the hit. The consumer may not take the hit so much later, but they are now. They are today because of rates today.
Yeah. How often does the Fed have meetings as it relates to interest rates? And what happens during those meetings, and how do those affect interest rates?
They call me on that, Jose, every month, and I give them no, just kidding. the the Fed can change a rate without meeting, and have done so in the past. But they usually meet almost every month. I think in December, and I think in August they don't meet. But it's a monthly meeting, and part of the meeting is to say what they pontificate to be the upcoming economy. Then they're going to say, this is what we're going to do about it. In the last year and a half, they have more or less kicked the can to the future and said, you know what, we think it's going to be okay. Because as little as 6 months ago, they said inflation will only be 2%, and if it goes up, it won't go up very much. Well, egg on their face is a bit of an understatement.
Well,
So,
and they use that wonderful word. They said it's going to be transitory.
yeah.
Which
And
I think for those who really know, you're like, that is a load of horseshit. Like transitory, like how that's not real. That's garbage,
Transitory is a word that they've also taken back. But you know what? Once the cat's out of the barn, or what, the cow's out of the barn, once the cow's out of the barn, that's life. The fact is that right now we have a very special piece of history to deal with. The first part of that special part is that there is more money available. The federal government is not going to withdraw a lot of money from the currency, from the circulation to the consumer. They're not. Because if they do that, we'll have a depression, and it'll be that quick. And that's where governments fall, because they need our money. And I'm not a pro or anti, this is not a pro or anti-government stance. It's just a fact of time that money is where you flow all the power. And I think what will occur with the Federal Reserve, and this is the good news, is that as rates come down, as we go into a recession near the end of the year and next quarter of next year, it's not that it's not that housing is going to be less expensive. That's a fallacy that people try to make. The fact is, if you're going to build ownership, if you're going to create wealth, it is not a short-term thing. It's a long-term thing. And owning a piece of real estate will, unless you really have terrible luck and buy at the wrong place in the wrong time and with the wrong people, you're going to build wealth. It's just that simple.
So are low interest rates bad for the economy?
Boy, that's an interesting, I've never thought about that. If something is false, when I was doing loans for people with a 1 7/8 note rate and a 2 1/4 APR, were they happy? Yes, but you know what they always said? Can you give me 1.5? I'm not kidding you. That was not an uncommon comment. But that's when that house was 700,000. That house is now $1 million. That was just 2 years ago. So I don't know is the direct answer to your question. I don't know. My guess is that whatever the market is now, seize the moment, Understand the market cycles change and be prepared for the cycles that are most probably going to occur. 7% interest rates will occur in the next year. Deflation of property values, at least in most of the markets that I see, is probably not going to occur because we have to double the inventory just to get a normal market. I know there are price changes out there, and I know there's different concessions that are being offered. But we've had a 40% run up in values in a lot of the US in the
Yeah.
last couple of years.
So in a way, I mean, it seems like there has to be some sort of deflation, like a deleveraging event, because there's a lot of leverage. It's interesting because when you asked that question, Jose, I thought about it and I'm like, well, I think it would be an interesting conversation to have about affordability, because we definitely have an affordability problem in the United States, and cheap money is what caused us to go up 30-40% in a very short period of time. And what that does is, to Bob's point, is that historically, like, Americans have, even though we're in one of the wealthiest countries in the world, we're not particularly good at saving money as a whole.
Mm.
And a home is really a forced savings account. It's forcing you to put money into a particular basket. And when things get unaffordable for people, it takes away most people, when they retire, the largest asset they own is their house. So if affordability becomes an issue and people aren't able to own, then you're taking away the vehicle that for most people is their largest asset, over their lifetime. So that's an interesting conversation to have, because the low interest rates is what causes a boom in prices, because money is very cheap.
Yeah. Bob, why are you so confident when you say interest rates will be at 7% within the next year? How are you so confident about that? Like, what metrics should somebody look at, or what data, or is it just a really smart person somewhere above saying, hey, look, interest rates will be at 7%?
I think interest rates will be at 7% for a brief time. I think that'll be a peak. I don't think it'll be more than a month. But and again, we're taking the Federal Reserve issue and we're moving it to the side now. Consumers want what they want. They want to have a payment that they can afford. The investor who buys the loan from the loan depots of the world, they want a yield on their money because they want to make sure that inflation doesn't eat them alive, because inflation is the number one problem for a person or an entity that buys mortgages as an investor. As we go through that business cycle, 8%, 8.5%, we'll hit a 10% calculation for annual inflation probably by, I'm going to say, October of this year. But the way that that's calculated is based upon only the last 12 months. And if you take a look at the inflation of last October, you're going to see that it will match what this October is. And guess what's going to happen in November? Inflation will start to go down.
Well, it's interesting because that calculation, too, to the best of my knowledge, they don't include two things that have inflated the most.
Yeah.
Which is energy and housing, which is like insane. So like when they say 8%, it's probably more like 15% or more, like, right?
How can it not be? Because our with gasoline prices where I live in Southern California have gone up $1.50 to $2 a gallon.
Yeah.
I mean, gracious me, oh my.
Like, and how are you not using that as part of the calculation? And what I'm aware of too, I was explaining this to Jose the other day, is that like if you have money in the bank right now, you effectively have a negative interest rate. It's not actually documented. It sits at 1, so you feel okay. It's not negative, but what's really happening is you have a negative interest rate. You are losing 6 to 7% of your money by having it just sit around.
Is it safe to say, Bob, that interest rates are supposed to be higher than inflation, or that's what it's supposed to be? So therefore, when we have high inflation, interest rates tend to go up because of the high inflation. And if interest rates aren't higher, that means the investor isn't getting a high enough return to keep up with inflation. Is that
That's a good correlation. Anything when it comes to the economics of interest rates and yields and long-term yields, I could say absolutely yes and absolutely no to what you just said. But I'm going to take that 90% of what you just said is on the beam. Because if you look at 1979 and 1980, when we had 11% inflation, we had 14, 15, and 16% interest rates. I did loans 16.5%, 4 points, and people were thrilled to get the money, but not a lot of people got the money. But the houses at that time were 80 grand. Those same houses now are $650,000, $700,000.
Well, I guess I'm wondering too, why do you feel that? Because I'm aware that Volcker did that very intentionally and purposefully, and it was painful and nobody wanted to do it, but he did it anyway. So like, why do you think we don't have to do that now in order to tamp down runaway inflation?
I think we might. I think we might. The fact is, the people that run the Federal Reserve right now, I'm going to give them the full credit that I hope they're due, and that is that they're being pragmatic and they're not trying to, because if they raise the federal discount rate 1.5% today, the market would freak out. Just imagine if you guys, I've had 13-year-olds. You have a 13-year-old and you say, I'm giving you a Coke every day. Here's your Coke. Here's your Coke. And then one day you don't give them the Coke. What are they going to do? They're not going to be happy. The consumer and Wall Street will not be happy with that. That's why they're incrementally increasing it. And just going back for just a moment, Jose, to your point of why do I feel so confident? And I wish I could use a different word, that we're going to be at 7% for a brief period of time, and that'll probably be in January of next year, is because it's just a cycle. It's not because interest rates want to be there. It's because the inflation will start to have come down. The investors will not have believed it yet. And by that time, the next month, they'll go, oh, yeah, okay. We're advising people right now to not pay points and be prepared for a 1.5% reduction in rates in early 2024 or late 2023, based upon that business cycle.
People have been talking about interest rates increasing now for like the last 2 to 3 years, or I've been hearing like, oh, the Fed's going to raise the interest rates. And they did in 2018. In 2018, they raised them, but then they brought them back down. Why are they increasing now and not in like when the conversations first started to happen?
I wish I could tell you, Mike, here's my guess, and it's a moderately educated guess, because again, as you probably do, I subscribe to very, very smart people. I pay a lot of money for their information. In 17, 18, and 19, the economy was actually really picking up. But the reason we didn't have inflation is because we didn't have a lot of money out, a lot of new money out there. With the COVID money coming out, that blew us up. I mean, that was probably $8 trillion. Well, heavens, that was like
Hey,
trillion with a T.
to use Bob's word, heavens me, like that, dude. Like people don't, you can't even like mentally comprehend. Like something I read something like 21% of all money in circulation was printed in like a very short period of time, like
Yes.
18 months. And how is it like logically? If you have more dollars, it's going to cost more dollars to buy the same things. That's inflation.
Bingo. To finish answering that particular question, Jose, because Aaron said it way better than I did. The ability for the government to control the economy, if you don't hear about any bad things in the economy, the government is smiling and they're just shutting up. But when things get bad, or when they look like they're going to get bad, in this case, the Federal Reserve is going to increase that rate. And as it slows down inflation, because by history it will it going forward? We don't know. Maybe it'll make it worse. It would be not the first time, but it would. It's only happened a couple times.
Yeah, so it's like clicking in my mind, and I appreciate your explanation. Where it's like, okay, let's say everybody has more dollars because 8 trillion gets pumped into a system. then things cost more. They just cost more dollars. It's not as much they actually go up in value per se. They just cost more dollars to buy the same stuff. Well, if you keep money cheap, that'll just keep happening and happening and happening in perpetuity. So in order to tamp that down, we make money more expensive. So we're like, whoop, your access to money becomes less. So therefore that should tamp down that upward trajectory that becomes not sustainable.
Does the market react in anticipation of the government increasing rates? Like, meaning like they've gone up. I've got a call from a lender the other day. They said that they've reached 6% in some cases. He said a sixth and an eighth. And I don't know if there was an announcement during that period, but does the market react prior to the Fed or the Federal Reserve announcing a higher Fed fund rate?
I work for a company called Loan Depot. They guess pretty well. It's called hedging, okay? Because they don't call it guessing. They call it hedging. Hedging just means, I think the rates are going to do this. So they put out a rate sheet for us. And if it turns out that they were wrong, then they're going to eat it. And then they're going to change the rates for future stuff and make it higher to catch up for the profit that they lost. But it's a guess and a bet or a hedging. If you use the word hedging, you're very cool and you're part of the lending industry. And, you know, it's a guess. It's a complete guess. Nobody knows. Because if they did, they'd have their own planet.
Yeah, and then what kind of happens is I could be wrong, is that like it gets priced into the market. So like what Bob was saying about like the adjustable rate mortgages, why they're so high right now is because they are hedging or betting that over the next 6 months rates are going to go up. So it gets priced into the market, right?
Yes.
I was going to ask you, why do different lenders have different interest rates? Like I hear consumers shop around sometimes like, oh, Bob Davis is offering me X, John Doe is offering me Y. Like if they all have access to the same rate, or don't they all have access aren't they all being offered the same rate by the federal fund? So why do they have different rates and different points?
No, they don't have the same. Federal and let's take the word federal funds and let's move that off the table, because that's not what you and I are talking about. We're talking about mortgages that are created by things called mortgage-backed securities. I was a mortgage broker, a one shop, one dude person for about 20 years. I went to different lenders to find where I could get the best rate for the customer and the best profit for me at the same rate. Those people have to go do all that work. Loan Depot, for example, is a multi-billion-dollar company. Citibank, Bank of America, Chase, they're big companies. They can go buy the same thing for less cost than the mortgage broker can. Consequently, when the Loan Depots or the Chase banks want to buy a type of business because they know hedging, they know that payment is going to be made on time more often than not, they're going to make that rate better. Well, what happens if Loan Depot doesn't think that's a good deal? We won't make that rate better. And when people come to us, we say, you know what? We're not the best place for you. Go to Chase. Now, we usually don't say that, but that's a gross example that's very important to understand, because if the consumer is going to shop around, they need to understand that apples and apples is the only way to shop.
Now, you mentioned something there which I think people could use some clarification on and some explanation to understand the way that machine works, and it all ties into interest rates. Is you mentioned a mortgage-backed security. And what I'm aware of is that the government has been buying hand over fist in exceptionally large quantities, mortgage-backed securities. So can you explain what that is and why them ceasing to buy all of that debt and all those types of securities, how that could affect markets?
First of all, a mortgage-backed security is in effect an ability for an investor to buy a product, a mortgage-backed security. They're buying a stock, if you will, and they're buying that stock that has invested usually in the $100 million deposit range. So there's usually $100 million in each of these mortgage-backed securities. They do go down to as low as 10 million, but most of them are 100 million. Like the trillion, it's like, how many millions? When an investor buys a mortgage-backed security, let's say in 3 years they go, you know what? I'm going to go buy an airplane now. I need to sell my position in this mortgage-backed security. They can sell that puppy just like that. If they actually bought the mortgage that we did, that mortgage is not as liquid. The mortgage-backed security is pretty near as liquid as cash is in today's market.
So it's kind of like a basket that has mortgages inside, and then that basket with all the mortgages inside gets sold.
Perfect example. That is excellent. To your second statement, which I'm not going to throw out all the numbers today because then my eyes will roll back in my head. If we had a 3 trillion with a T mortgage market last year, and this year we're going to have a 2 trillion mortgage market. About a third of all those mortgages were bought by the Federal Reserve. They're going to cut it down to zero. So guess what? It's not going to have a significant effect because there's a lot less product to buy, and the same people that have been buying it are going to still buy it.
Oh, that's interesting. So in other words, due to the fact that a third of the amount of mortgage-backed securities that'll be available, it's going to be offset by the fact that a third of the purchasing is not going to be done by the federal government.
Right. And they're still purchasing because when a loan gets paid off, they're still buying new mortgage-backed securities with that money, but they have every intent of stopping that by the end of summer. And you know what? If they were to continue to buy them at the rate they were going, they would probably own 2/3 of the market of all the mortgages. And that is not healthy for any entity to have 2/3.
That's crazy, Bob. I never would have thought of that because what that means is that the federal government would essentially, because we say like, this is my home. I'm like, really? Don't make your payments. See whose home it is, right? So like essentially at that pace, the government would own 2/3 of all the homes in the United States.
Right.
Basically, when somebody goes to the bank and they're getting a mortgage with an interest rate on a property, can they buy that down? And if so, is it good to buy the interest rate down or not?
Yes, they can buy the interest rate down either on an adjustable or a fixed. If it's a 5-year or a 30-year, and now I guess we're coming out with 40-year loans, you can buy the rate down. Is it a good idea to do it? I'd like to say that I'm really a sophisticated guy. I am not a sophisticated guy. Mm-hmm. If it's going to cost you $10,000 to pay to buy the rate down, and if you're going to save $100 a month by paying that $10,000, you have how many months before you get your money back?
Yeah.
In the market that we are currently in, if you are average, nobody wants to be average, but if you're average, that means in 5 years, you're going to do something with that mortgage. That's only 60 months. That means you've just wasted a bunch of money. Generally speaking, buy downs are usually, well, at least up until right now, we haven't been using buy downs much at all since the late 90s because they haven't been needed. It's just like the adjustable. Why get an adjustable at 5 1/4 when you can get a fixed for 5 1/2?
Well, and it sounds like, if I'm understanding you correctly, what you'll see more of is 40-year loans and adjustable rate mortgages.
Well, and the interest-only loan is coming out. I happen to have a personal disagreement with that whole concept. Unless you're a sophisticated investor, then that's a different story. But for a homeowner that it's their one home and it's their wealth building capacity, an interest-only loan, which is only interest-only at the most for 10 years, really takes advantage of the consumer because they think they're getting away with something when in fact they're betting on equity buildup. And in some parts of our country, that's just not real.
Yeah. And then, so what's interesting is all of those products are in an effort to make it more affordable, so people can afford payments. That's it.
Homeownership is the key factor. And, let's face it, people like me say, we're all about homeownership. The local board of realtors says the same thing. The fact is, guys, what's right for a human being. Owning a home is not a right. It is maybe a rite of passage, but it's not a right. And it's not right for everybody. But if it's right for you, how do you know? Well, that's why you have to talk to professionals to get the right advice.
Yeah. What does APR actually stand for?
Thank you for asking me that. I meant to bring that up earlier. APR stands for annual percentage rate.
Uh-huh.
And there's a very specific equation, which I will not go into today. But if you can take the following figures, let's just assume for just a moment a 30-year mortgage. Take all your payments over 30 years. Take your closing charges that you paid at closing, not just lender fees, but most other charges. Divide that by the time and the interest, and the principal balance, and that is how you might get previously a 5% interest rate, but have an APR of 5.25 because your escrow fee is included, your prepaid interest is included, your appraisal fee is included, any lender fees are included. So you can also see that if you borrow $1.5 million, the difference between the note rate and APR, Jose, is not much different. But if you're borrowing a couple $100,000, you can easily see a 0.5 or 0.75% increase in the APR versus the note rate. So when a consumer asks what's your APR, my first question is, do you have a loan estimate? Because they're asking a technically based and good question, but it may not give them the right answer because an APR can be completely manipulated by the lender.
How does somebody shop interest rates? Like because it sounds like there's obviously more than the interest rate that you're getting. Because let's say you're getting a slightly lower interest rate, but you're getting substantially higher closing costs. That would affect the APR. So if I was a consumer and I was interviewing different brokers and I wanted to get the best deal on a mortgage rate, what questions should I be asking?
The first thing that I recommend to people, and in direct answer to your question, there's a document and it's called the loan estimate. And it sounds very mundane, but it's a federally created document that when you apply for a mortgage, the lender must, not option, must give that to you within 3 business days. And it will break down all the charges because the lender is responsible even for for escrow and title fees and recording charge. They're responsible for that reporting. So if the loan estimate is in the possession of the consumer, they have the best option to take that and go to the next lender and say, show me yours. And there's no reason to hide it because if Loan Depot, for example, has one, if Chase has one, if another company has one, the good thing for the consumer, it's the same form. It's just different numbers. And that's what they want to look at for the numbers. But it can still be manipulated until that loan is locked in by the lender. And it's legal. I'm just not sure how moral it is. So the first thing is get a loan estimate. The second thing to do is to understand and ask the question of the lender. What are the benefits? And I'm not talking about being sweet and kind and we provide good coffee. What are the benefits of doing business with your company? Why do I want to do business with you? Because are you going to sell my loan? Are you going to keep my loan? What's the cost for that? Is there a cost for it? And the things that are important to the consumer, and as the professional realtor, Jose, those are things that when you tell them what to ask or they find out what to ask, well, I'll tell you what, they become the smarter consumer, and what they do is they become far greater advocates for all of us.
Novello, any other questions, bro?
Yeah, I mean, I think this has been great. Like I've learned, I've taken notes. Like I really appreciate you taking the time. And people in your geographic area are like lucky to have you as a resource, and they should definitely reach out to you and do so.
Anything else that you think we should know about mortgage interest rates, and how they work? And then if not, where can people find you as well too?
Well, first of all, thanks. The thing, because we are in a season, in a business cycle, using my bald head as an example, all of our hair's been pulled out because we, 3 months ago we were in the mid threes. Now we're in the mid fives. Holy smokes. What do you do with that? It takes a little more time to talk to experienced people and just listen, read, know the internet is a bunch of lies, but Wall Street Journal and some solid periodic information, great data. A professional realtor has to be on it and be aware of what's in their market because for example, in the Texas market, you're looking at 6.25 for the same thing that's in Southern California is 5.5. So if you are in Southern California going to Texas to buy and you hear 6.25, you go, oh, I'm not talking to them. Well, areas of the country are different. It's just like whenever you need an attorney, you don't want one. But if you don't have a great one, you're toast. My name is Bob Davis. I work with a company called Loan Depot, and thebobdavis.com is the website that they've approved that I can use because I can't use the other one that I've used for 30 years, 20 years. But the important thing is that I am just thrilled to be here today because you guys are asking questions that I wish people would ask. And it's not that I have all the answers because I don't. But together we can figure out how to deliver data to the consumer so they have the best data to make the best decision.
Bob, I wanted to just say thank you from the bottom of my heart. I appreciate obviously you sharing all this information. Obviously, I don't know if you recall this, but when I was a new agent back in the day, you used to do like presentations, and I learned a lot of stuff from you back then. So I appreciate reconnecting with you. I appreciate obviously you being on the show. For all of our viewers out there, this was episode number 116. We had Bob Davis with Loan Depot. He explained to us how mortgage rates work, why mortgage rates go up, why mortgage rates go down. If you've enjoyed this interview, don't forget to hit that subscribe button. If you feel that this interview will add any value to any friends, family, neighbors, make sure to hit that share button. And once again, thank you so much, Bob. Thank you, Aaron. And stay tuned for the next episode, gentlemen and ladies.